And Bitcoin just is now correlated to that dynamic because it's owned by the same portfolio managers in a multi-asset framework where they're underwriting that to be a risk asset.
Bitcoin row. And so that's why I was saying, well, you just wrote a great article on that. And I kind of think about the world the same way.
What Warsh has shown is Bitcoin's correlation to risk assets in general are at an all-time high. Because I think what happened with the Warsh announcement wasn't necessarily a Bitcoin sell-off, but it was actually a risk sell-off.
The issuers of digital credit have to sell Bitcoin to not be able to meet their interest payments. If they don't have to sell Bitcoin and they made interest payments, then you get a 3-year track record. That's the best 3-year track record that you possibly could have to say, this is how it performed in a bear market. You don't have to model it and think and hope. We can actually show you.
If Warsh successfully rips the Band-Aid and begins a structural balance sheet reduction, it will be painful for risk assets in the short term. We're seeing that correlation right now. But long term, it is the most bullish thing possible for Bitcoin. Why? Because it restores the idea of a true store of value. In an anti-fragile world where the Fed is no longer the primary engine of asset prices, a non-debasable, decentralized reserve asset like Bitcoin becomes the only logical anchor for global finance. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
About Bitcoin row. And so that's why I was saying, well, you just wrote a great article on that. And I kind of think about the world the same way. And so first off, when you zoom out and you look at Bitcoin from any 4-year period, nothing has changed. We are in the business of underwriting volatility. And so what I mean by that is, I don't know about you guys, I didn't predict that Bitcoin was going to be where it is today, but I did expect 50% drawdowns still as a regular occurrence in the forward-looking view of what we expected Bitcoin to do. And our company view, and this is just kind of coming from a pension background, is if I can underwrite time and direction, then I don't have to forecast an individual quarter or an individual year. And so my thing is, has the fundamentals changed? Is the US still taking out debt at an unsustainable rate? I think the answer is yes. I don't know if you have a view that the debt crisis will be solved in the near future.
I think it's going to be worse.
I think it's going to be worse, right? And so if that's the view, then really this drawdown is nothing to be out of the ordinary, and the fundamentals haven't changed. And so we just ride it out. I think Warsh had something to do with it, which we can get into. But I think nothing has changed. And so we just write it out and question if the fundamentals have changed. And I don't think they have.
What Warsh has shown is Bitcoin's correlation to risk assets in general are at an all-time high. Because I think what happened with the Warsh announcement wasn't necessarily a Bitcoin sell-off, but it was actually a risk sell-off. And that correlation has increased pretty dramatically, I would say, since last summer, and got accentuated even with the news flow today. So I think there's two versions of the story, right? Because on one hand, there is this hawkish version of balance sheet reduction as a journey that we have not ventured into beyond what this ample reserve system could look like. And there's a lot of uncertainty about this, which is why I think you can see risk assets generally being sold off. And Bitcoin just is now correlated to that dynamic because it's owned by the same portfolio managers in a multi-asset framework where they're underwriting that to be a risk asset. But the thing that I'm long-term really bullish about Warsh is if he actually is able to be what I call like a very pragmatic economist to like rewriting the engines of what Fed independence should look like. There's a version where like the whole monetary setup as we know it is finally going to evolve into something that is a little bit more anti-fragile. And in that world, there's a restoration of what true store value could look like as a reserve asset. So long term, I do feel like it's a little bit painful always to kind of introduce volatility to change from an institution that we've gotten very comfortable with. But deep down, like we all know the current system's not on a good path and we have to start like ripping the Band-Aid a little bit. But long term, like his holy grail towards what he wants the Fed to be and what he thinks the role of like the interest rate should be I think all of that points towards a pretty positive, healthy mood for Bitcoin in the future.
So I have a question for you guys, because I follow you guys very closely. And I'm going to frame it with a viewpoint and then a question to see how hard you will push back on this viewpoint. Okay, so my own personal journey as someone that was, a portfolio manager, I managed a lot of treasuries, right? So my journey to be why I was a Bitcoiner was those conversations with the Fed, feeling like I was being gaslit and seeing the printing of money. And Warsh had a similar viewpoint at that time, that QE would be inflationary and was very negative on QE, but now seems to be aligned with the viewpoint that the future is more deflationary from AI than inflationary. And so my viewpoint on if I was the Fed chair would be original QE, I would have been negative on it. That would cause inflation. And I think it did cause asset price inflation, not CPI inflation. But if I view the future risk as deflation, then my viewpoint might be different today than it was in the past on QE or the size of the balance sheet. So do you think that there's a chance that in the Senate confirmation process, when they're grilling him and asking him questions, right? Like who's going to be grilling him? It's the Senate and the House, the people that can't get their stuff together and want to borrow money. So if Warsh goes in there and says, yeah, I'm going to shrink the balance sheet, I'm not going to give you guys the drugs that we've been giving, I don't know if they confirm him, but do you think he comes in maybe as more of a dove than the market might anticipate?
Absolutely. And I think there's a thing that people forget. Kevin Warsh actually, from his first term as Fed governor, resigned. And he actually left. And the reason he left was because he disagreed with the committee at the time of engaging in a second round of QE. Because he knew the first time when it happened in '08 what it took. But what he was against was this idea of complacency, that now the QE framework is the backbone of the entire global financial framework, where moral hazard is changing the cost of capital. And he was vehemently opposed to it to the point where actually he resigned, right? So I think this is incredible. We have an elite academic who's also a huge capital markets practitioner, right? From Duquesne and Druckenmiller's days, and actually has the guts to just call the shots as he sees it. And that kind of iconoclastic regulator type personality is so far, as we all now see in the world, that if anyone can ever actually go on the venture of a new Treasury Fed Accord to reset people's expectations on the role of the dollar, I think this is it. I think this is the very powerful combination of personalities and expertise and culture that I don't know if we'll ever get a chance to replicate. So I'm just personally very excited to see what's going to come through with it. And I think it is long-term very, very positive for Bitcoin.
One, so excited, but two, kind of understanding why the market might throw a short-term fit, right? The market has gotten so used to this, we're going to give you some drugs, some medicine that doesn't fix the underlying problem, but to make you feel okay. And that reduces volatility, pushes asset prices up. When you have someone that's forward-looking like Warsh, that I think understands that the Fed is not independent, which, I mean, in this group, it's that's almost like a laughable thing.
What a genius.
But just coming back from my old seat at CalPERS, a lot of institutions still tended to fall to that bias of the perception of Fed independence, that you would have, Janet Yellen, swear to the core, the Fed is independent, and that there's not some, kind of backdoor, quasi handshake dealing and to just say look, there's going to be an accord between the Fed and the Treasury, that we're going to be thinking together. We're going to be thinking forward looking, not backward looking. I say that's about the most bullish thing that I could possibly.
It's no longer enough to just hold Bitcoin. The next version of the Bitcoin company will be about making that Bitcoin productive. Whether it's through call overrights, cash-covered puts, or sophisticated lending, the goal is to turn digital gold into a yield engine. We are moving from a world of passive holding to a world of active capital management.
The credit market in the end is an incredibly abundant and large market that even though retail investors don't participate in, is kind of the core of our financial system. And so in this world where people are starved for yield and they're actually trying to think about where to earn appropriate yield that measures up to growth expectations, we think we're in a period of decent yield because the Fed's rate that's at 3.5 or whatever. But actually what we've seen is on a real rate, that's actually been pretty deflationary too, right? I think there's data that now show most people who started their entry-level jobs post-college were now on the 6th year of their real wage having gone down. So there's actually like a real problem with like yield as a concept, even away from like nominal numbers. And the thing about Bitcoin is that like if you believe in the price appreciation that is possible over a long time frame, you can think about risk segmentation, where people would choose to take something current today versus the volatility of underwriting the uncertainty of tomorrow. And so to me, I think it's a big market, and it's also a market that is heavily dictated by regulators in kind of like a box checking format, right? Like what I mean to say is like credit ratings matter, and to get credit ratings, you got to be able to do things that hasn't been done before. And so like there's things that just have to get solved. But yesterday I saw Ledin actually issued an ABS securitization for the first time that the S&P actually graded. And it was like a $200 million program where the junior piece was rated B-, right? The equity tranche of an ABS securitization was rated B-. That's the same credit rating as MicroStrategy, which actually would have a senior credit relative to all the other equity things they have in the past. All to say, I don't think the S&P knows what they're doing. Like, I actually don't think people have an understanding of like what the appropriate credit rating should be on these things. And that's basically an opportunity for somebody who is smart and clever to think about what that appropriate risk-adjusted return is. And people are going to figure it out. And so I think it's a question of like just risk tranching and risk preferences. And because we all know in the end, institutions, right, they're motivated by different things than principal investors like you and I that are here. They actually have, you know, a lot more guardrails as to how they're measured on their performance success, the volatility drawdowns, and the current operating needs that they have to support. And credit just fits a role that Bitcoin historically, because it is a non-cash flowing asset, could never tap into. And this digital credit finally opens a path, an aperture for that class of investors to come in, which I think is huge.
So maybe taking my old seat at CalPERS for a second and talk about kind of a few different ways to view digital credit. So one, digital credit's been around for just over a year now. For an institution, you need anything that you're going to invest in, unless you're just going to invest like a couple dollars just to watch it, to have a track record. Track records are a minimum of 3 years. And that 3-year period is not typically, I'm going to cut you a multi-billion-dollar check at year 3 in one day. It's that once you have a track record, we can start to assess what the risk and return opportunity of this asset is. And so I think sometimes people think, oh, like, when is CalPERS going to buy SATA or Stretch? They might buy it tomorrow. I mean, I have a lot of friends there, but I think the real conversation is they need to see a track record. And so what helps build a track record? There's nothing better to build a track record than a bear market, actually. And if in a bear market where a lot of the people that are watching this from the outside are expecting the issuers of digital credit to have to sell Bitcoin to not be able to meet their interest payments, if they don't have to sell Bitcoin and they made interest payments, then you get a 3-year track record. That's the best 3-year track record that you possibly could have to say, this is how it performed in a bear market. You don't have to model it and think and hope. We can actually show you that. So from that perspective, I think we're in a great time to build digital credit. And then the second thing is, well, what does the risk return opportunity look like? We're learning about the volatility of these instruments as we speak, right? They how the market treats them. And I think the TLDR is that I view them as investment grade credit. S&P doesn't know what they're talking about. They give 0 credit to Bitcoin, but the market is assigning basically a almost 2 times of the yield of high yield. So the market is assigning a very high risk to these assets. So the market is disconnected. That's an opportunity for people that can underwrite Bitcoin risk. But if you're a pension, how do pensions think? They think, how do I earn a 7% yield over the long term? And how they construct their portfolio is the fixed income side is less than 7%. And then the equity side is more than 7%. And they try to blend that together to earn 7%. If someone could go in there and say, here's income that's 10% or 11% or 12%. So it's income, but it's offensive income versus negative, defensive income. And we have a track record through a bear market. That starts to become interesting, but we're so early in the process. It's going to be a multi-year process. And so for now, I think it's more people that don't have those restrictions only. We love a simple capital structure, but we've been very open that for on the common side, the goal is going to be to manage our balance sheet, have the amplification ratio that we want. And we think because of the relative small size of Strive versus a strategy, that there's a high chance that SETA might be able to grow with our common over time and just grow the size of SETA. If there was some scenario where we needed additional digital credit and SETA was not able to meet that, then we would consider another digital credit offering. But at this point, that's not the base case.
Jeff, talk a little bit about the yield generation and how you as an investor would think about investing in maybe digital credit versus, traditional fixed income.
Yeah, I think what's really kind of amazing could be if there was a way to make your underlying collateral even more productive to be able to be the source of the current obligations on those liabilities. I think that is kind of one version that is easy for everyone to understand, which is people are worried about, well, where's the cash flow going to come from if Bitcoin's actually kind of, you're hoping for the price appreciation for which we're all assuming that value has to be realized, right, at some level. And if you could just maybe make Bitcoin a little more productive where it can generate yield because it can participate in the capital markets in a healthy way, I think, when you put those things together, it makes the story much more digestible and rational and in some ways risk reduced. And so with Bitcoin in particular, I've always said, and I'll say it again, the volatility is the best part of why that asset is valuable. And if you can monetize that volatility by doing some call overrights or cash cover put sellings or other kinds of things around it where you're being paid essentially to be patient, you can actually then make that into a yield engine where you can either give it to the pref holders as interest income, or you can use it to buy more Bitcoin on the balance sheet with that organic kind of yield generation. So I think the next versions of Bitcoin treasury companies we'll continue to see will probably fall into that kind of more kind of advanced operation of trying to make the Bitcoin useful somehow, or finding cash flows adjacent to Bitcoin that can also bring more utility to the underlying balance sheet.
If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.